All right, future CAs, welcome. We're diving deep into employee cost today. This is one of those chapters where if you get the concepts right, you can absolutely score full marks. And that's exactly what we're going to do. Nail every single concept one by one. So let's just jump right in with a question. Look at this. What's your first instinct? Just divide the total pay by 2,400 hours? Well, hold on a second. This right here, this is a classic ICAI exam trap. So many marks are lost on questions just like this. But don't worry, by the time we're done here, you'll see this trap from a mile away and know exactly what to do.
Because that's the whole point, isn't it? Our job as cost accountants isn't just bookkeeping. It's about being a detective, finding the true effective cost of everything, especially our people. Getting this right is how companies make smart decisions. And today, we're going to master it. Okay, Section 1, Decoding Employee Cost. Now, I know you might be tempted to think, oh, this is the easy stuff, but trust me, getting these fundamentals locked down is absolutely crucial. Every complex problem ICAI throws at you is built on this foundation.
So what even is employee cost? The official definition says it's all benefits, not just the salary that you pay or owe to any employee, whether they're permanent or just temporary. And a key thing to remember here is that it includes both cold, hard cash and benefits in kind, like company-provided food or housing. Now here's where people trip up. Look at this list. Of course you have wages and allowances, but pay close attention to this one, employers' PF and ESI contributions. This is a huge trap. ICAI loves to check if you remember to add the employer's contribution to the total cost. It's not just a deduction from the employee's pay, it's an extra cost for the company, and it has to be included. Next up, a super fundamental concept, direct versus indirect. Think about it like this. A direct employee is the person literally on the assembly line building the car. You can trace their wages directly to that car. An indirect employee is their supervisor. The supervisor's salary helps make all the cars, so you have to spread or apportion their cost over all the units. Getting this distinction right is the backbone of a proper cost sheet. Okay, so we know what the cost is made of, but how does a company actually manage all this? This section is about the process, the system. And it's not just about paying people on time, it's about having controls to make sure the numbers are right and to prevent any fraud. You can see from this diagram, it's like a relay race. It's not just one department's job. Information gets handed off from timekeeping to HR to the payroll department and finally to accounts. Each one has a specific role to play in getting the final paycheck right. Let's break that race down. Step 1, timekeeping tracks who showed up and for how long. Step 2, HR provides the master list of who works there and what their pay rate is. Step 3, the number crunchers in payroll take that data and calculate the gross pay. Step 4, accounts steps in, handles all the deductions, and pays out the net amount. And Step 5, which is super important, they make sure all the statutory money, both the employees and employers' share, gets paid to the government. It's a clean, logical, and auditable trail. And here we are, Section 3. Let's circle back to that question from the start, the one about the 400 unproductive hours. This is where we tackle it. We're talking about idle time, and folks, this is probably one of the most tested and trickiest concepts in this entire chapter. You have to master this. So what is it? In the simplest terms, it's time you pay for but get nothing out of. You pay an employee for 8 hours because they were at the factory, that's time paid. But they only spent 7 hours working on actual jobs, that's time booked. That 1 hour gap, that's your idle time. Now this slide is everything. This is where the marks are. Not all idle time is the same. Normal idle time is unavoidable. Tea breaks, walking from one machine to another. Think of it as the cost of doing business. You absorb this cost into your product by inflating the hourly rate. But abnormal idle time is different. This is avoidable stuff, a machine breakdown, a power cut. This is a pure loss. It goes straight to the costing P&L account and never, ever becomes part of your product's cost. Burn that into your brain. So let's solve that puzzle from the beginning. First, we add up the total cost of the employee for the year. Don't forget that employer's PF contribution. That gets us to $2,117,200. Now here's the magic step. Do not divide by 2,400. That's the trap. You take the 2,400 hours paid and subtract the 400 hours of normal idle time. That leaves you with 2,000 effective productive hours. Divide the total cost by these effective hours and you get the real cost, $108.60 per productive hour. See? Moving on. And just when you thought you were safe, we have another IPI favorite, overtime. The trick here isn't about calculating the overtime pay. That's easy.
The challenge, and where everyone gets confused, is how you treat the extra bit, the premium in your cost books. This table is your cheat sheet. The treatment depends entirely on one question. Why did we do the overtime? If a customer wanted a rush job, they pay for it, charge it directly to their job. If the whole factory is just busy, it's a general production overhead. If there was a flood or a fire, well, that's an abnormal event, so it goes to the costing P&L. And if it's happening all the time because you're short-staffed, you treat it just like normal idle time and inflate the wage rate. Let's see this in action. Part 1 of the problem is just figuring out the total cost to the company for worker A and worker B. So we calculate their gross wages, which includes that overtime for worker A. Then, and we're not going to forget this, we add the company's own PF and ESI contributions. That gives us our total cost to account for, $17,500 for A and $25,600 for B. Okay, now for part 2, where does all this money get charged? Their regular wages are split across the jobs they worked on, but look closely at worker A's overtime of $1,500. The question tells us it was specifically for job Y, so boom, the entire $1,500 gets charged directly to job Y. This is a perfect textbook example of that first rule from our overtime table, incentive plans. This is where we get into the calculations. So, how do you motivate workers to finish a job faster than planned? Simple. You give them a bonus for it. We're going to focus on the 2 big ones you need to know, Halsey and Rowan. First up, we have Halsey. Halsey is the simple one. Think of it as a let's go 50-50 deal. The worker gets paid for the time they actually worked, guaranteed. But for any time they saved compared to the standard time, the company and the worker split the benefit. The worker gets a bonus equal to 50% of the wages for the time saved. Simple as that. Now, Rowan is a little bit more of a head-scratcher, but it's totally manageable. You still get your guaranteed wage for the time you took, but the bonus is calculated differently. It's based on a proportion. You figure out what percentage of the standard time was saved. If you save 2 hours on a 10-hour job, you save 20%. You then get a 20% bonus on top of the wages for the time you took. It's a bit more complex, right? So what's the real difference? This is a very common theory question. Halsey is like a rocket ship. The more efficient you are, the more you earn, with no real limit. It's a powerful incentive. Rowan, on the other hand, has a kind of built-in safety net for the employer. The bonus still goes up with efficiency, but it starts to level off. This protects the company from paying out crazy bonuses if they accidentally set the standard time way too high. And this chart shows that perfectly. Look on the left. When a worker saves 50% of the time, both plans pay out the exact same hourly rate. But now, look to the right. When the worker gets really efficient and saves 75% of the time, look what happens. Halsey's payout goes through the roof, all the way to 20. Rowan's goes up too, but it starts to taper off at 14. That's that employer protection we were talking about, right there in the numbers. The classification of costs. So let's start with a classic, a real exam favorite. Is factory rent a production cost? Or is it an administration cost? Seems easy, right? But believe me, how you answer this one question can totally throw off your final cost of sales. And that's exactly why we're doing this. This isn't just about memorizing definitions. It's about grabbing those marks that can make all the difference. In this explainer, we're going to break down the entire system so that you can tackle questions just like this with absolute confidence. But hang on, before we start classifying everything, it's super important to understand something a lot of students skip over. Cost accounting as a system, well, it's not perfect. It has a few built-in limitations, and knowing them gives you that extra bit of context that ICAI really looks for. So what are these limitations? Well, first off, it's expensive. I mean, all this detailed work, analyzing, allocating, absorbing costs. It takes time, it takes people, it takes money. Second, it requires reconciliation. The profit you get from your cost sheet and the profit in your main financial accounts, they're often different. So you actually have to prepare a whole separate statement to explain why. And third, it can feel like a duplication of work because you're basically running 2 sets of books, your financial books and your cost books. Okay, with that little bit of theory out of the way, let's get to the main event. Imagine trying to figure out the cost of a single cup of coffee. You've got the coffee beans, the milk, the sugar, the paper cup, the barista salary, the rent for the shop, the electricity bill. It's a huge mess of costs. To make any sense of it, you need a system. And that system is classification. And here it is. This is our game plan for this explainer. We are going to walk through the 6 main ways we can classify costs. We'll start with the most basic one, by nature or element, and then we'll build our way up to the more complex stuff that managers use for making big decisions. First up, classification by nature. or as it's more commonly called, by element. This is the absolute ground floor. Every single cost you will ever come across can be broken down into just one of three simple building blocks: material, labor, or other expenses. That's it.
Now take a good look at this chart. This is your entire costing universe on one slide. See up at the top? You've got your three core elements. Each of those then gets split into direct and indirect. All the direct costs, when you add them up, give you your prime cost. And all the indirect costs get bundled together into what we call overheads. Burn this chart into your brain. It's your anchor for everything.
So let's start with material. Direct material is the obvious stuff. It's the cost of the things you can actually see and point to in the final product, like the cloth used to make a dress. Indirect material is the other stuff, like the thread used to stitch that dress. You know it's there, but you can't easily trace it. Now listen very carefully, because this is where marks are lost. Sometimes a material might seem direct, but it's so small or cheap that it's just not practical or economically feasible to track it per dress. In that case, we just treat it as indirect material. ICII absolutely loves to test this little exception.
Next, we've got labor. And this one is pretty straightforward. Direct labor is simply the wages you pay to the workers who are physically hands-on turning the raw materials into the finished product. The person running the machine, the person assembling the parts. That's it. So what about everyone else in the factory? The supervisor, the security guard, the cleaning crew, all of their wages are considered indirect labor.
So we have direct material, direct labor, and the third and final piece of our prime cost is direct expenses. Think of these as any other expense that's not material or labor that you incur for one specific product or one specific job. The textbook example is if you have to hire a special machine just for one customer's order. That hire charge isn't material, it's not labor, but it's directly tied to that single job.
Okay, so what did we do with all those indirects we mentioned? Well, we bundle them all together. The sum of indirect material, indirect labor, and indirect expenses gives us what we call overheads, and this is a huge area on your cost sheet. We then split these overheads into 4 groups based on where the cost happened. You've got production overheads, which are all your factory costs, like factory rent. You've got administration overheads, which are your main office costs. Then selling overheads for all your marketing and sales efforts. And finally, distribution overheads for everything related to getting the product out the door and to the customer.
So we've classified costs by their basic element. Now let's move on and look at the exact same costs, but from a different angle. This time, we're going to group them by the business function they support. This is classification by function. This slide right here is basically the skeleton of a cost sheet. You see how it flows? You start with your prime cost. That's your 3 direct costs added together. Then you add your factory overheads, and boom, you've got your factory cost. After that, you add your administration overheads, which gives you the cost of goods sold. And finally, you add your selling and distribution overheads to arrive at the total cost of sales. Knowing this sequence, this flow, it's absolutely non-negotiable for your exam. Let's keep moving. Our third way of classifying costs is a real game changer, especially for making decisions. Here, we don't care about what the cost is or where it happened. We only care about one thing. How does this cost react when we produce more or less stuff? This is classification by behavior. First, we've got fixed costs. These are the easy ones. They are costs that stay the same in total no matter if you make 1 unit or 1,000 units. The best example is your factory rent. You pay the same rent every month, right? But, and this is a very important but that ICAI loves to test, fixed costs are only fixed within a certain range. If you suddenly need to double your production, you might have to rent a second factory. And then your total rent cost isn't fixed anymore. It just jumped to a new level. So it's fixed, but only within a relevant range. Now, on the complete opposite side, you have variable costs. With these, the cost per unit stays the same, but the total cost goes up and down directly with your production. Think about the cloth for the dresses. The cost per dress is fixed, but the more dresses you make, the more your total cloth cost will be. Simple. And then, sitting right in the middle, you have semi-variable costs. These guys are part fixed, part variable. The classic example is your telephone bill. You've got a fixed monthly rental charge plus a variable charge for every call you actually make. So the total bill changes with usage, but not perfectly in line with it. Okay, we have covered the big 3 classifications: by element, by function, and by behavior. Now let's pick up the pace a little bit. We're going to do a rapid-fire round of the remaining classifications. These terms are super important for theory questions and for understanding management accounting. So let's nail them down quick and clear. Next up, controllability. Now, the key thing to get here is that no cost is just controllable on its own.
It's all about perspective. A cost is controllable if a specific manager has the power to influence it. For instance, the amount of raw material used might be controllable by the supervisor on the factory floor. But the rent for that factory, the supervisor can't do anything about that. For him, it's uncontrollable. But for the senior manager who signed the rental agreement, it's very much a controllable cost. It all depends on who you're asking.
Okay, how about normality? A normal cost is basically the cost you expect to pay to get the job done under normal conditions. This is part of your cost of production. An abnormal cost, though, is something totally unexpected. A major flood in the warehouse that ruins materials, for example. And here's the crucial part. You never, ever include abnormal costs in your cost of production. Instead, it gets charged straight to the costing profit and loss account. Now, this next one is a pretty subtle difference, but it's important. A predetermined cost is just any cost you figure out before you start production. It's an estimate. But a standard cost is a very special, very specific type of predetermined cost. It's not just a guess, it's a target. It's what the cost should be if everything runs perfectly and efficiently. It's a benchmark.
Let's talk about differential cost. This is a huge concept for making decisions. All it means is the difference in total cost between two different options, or two alternatives. And if that change makes your costs go up, we call it an incremental cost. If the change makes your costs go down, you guessed it, we call it a decremental cost.
Two more quick ones for you here. First, imputed costs. These are also called notional costs. Basically, they're pretend costs. There's no actual cash payment involved, but we include them when making decisions to get a fairer comparison. The classic example is if you own your factory, you might charge a notional rent to it, just so you can properly compare its performance against a factory you are actually renting. On the other hand, engineered costs are costs that have a super clear, direct cause and effect link between the input and the output, like the exact amount of steel needed to build one car. And last but not least, we have explicit costs. You might also hear these called out-of-pocket costs. And they're the total opposite of those imputed costs we just talked about. These are all the costs that involve a real, actual cash payment. Right now, we're talking salaries, wages, the rent you actually pay, interest on a bank loan. These are the costs that hit your bank account. And there you have it. That is the full rundown of cost classification, a fundamental toolkit for every future chartered accountant.